Good evening, everyone. Hope you have noted the next two FOF dates. Those who have not realized, this is a continuation of the wealth management series that we are doing, wealth management stroke personal finance series. So where we had two sessions on real estate, one on the real estate sector where we had a guest speaker, and second one specifically on the co-working spaces. One we did on the wealth management industry, and then a couple of sessions from Raji where he spoke about what to do once you are rich and about the family businesses. Then over the past 2 months, we have had two sessions, one on insurance and one on the legal side, estate planning. And now today so today's topic is tax. Though tax is a very, very broad topic, so I'll be covering specific aspects of personal taxation only. And some of it is not directly related to taxation, but it can help in tax planning for some of you. Just a disclaimer, I am not a practicing tax expert, though I am a chartered accountant. Consult your tax advisor before you take any action. And pardon me if I am not able to answer any questions in the Q&A session. So instead of telling what I am covering today, what I am not covering today is transfer pricing, TDS provisions, angel or startup taxation, anything related to companies, LLP, trusts, partnership firms, etc. because this is related to only personal finance and personal taxation. Nothing related to deductions, exemptions, GST, indirect taxation, etc. Tax is a very, very vast topic, and our respected finance ministers give us new and new material every year to study, and they make it more complicated so that chartered accountants like me survive in this world. So just like our finance minister divides her budget speech into two parts, part A and part B, we will also have two parts. Part A is individual taxation, and just like in the budget speech, no one is interested in part A. Here also, most of you would be aware of what is there in the part A. We'll move on to the complex topics in part B. So just two concepts of assessment year and previous year. So year in which your income is assessed and the year in which you pay your taxes is called the assessment year. And previous year is basically the financial year before the assessment year. So just to give you an example, any income earned in the financial year 23-24 will be assessed in the next assessment year, which is called assessment year 24-25. Coming to the legal status of different categories for taxation purposes, individuals, HUFs, companies, LLPs, partnership firms, association of persons or body of individuals. So this would include your clubs, this would include your cooperative societies. Local authorities would include your municipal corporations, and artificial judicial persons are basically, sorry, just there's some disturbance here. Artificial judicial person is basically a public corporation established under a special act or legislation. Coming to the basic heads of income where you're taxed under different heads. One is salaries, where your Form 16 takes care of it. Under that you have your basic salary, HRA, all your allowances, and then you get a standard deduction. Then you have under house property, whatever rental income that you are earning, that is taxed, and from that you get a standard 30% deduction for all the expenses that you have on your house properties. Under business or profession, any businesses that you have, any business income, be it income from partnership firms or be it income from proprietorship firms or derivatives income, all that comes under business or profession. Capital gains is divided into short-term and long-term capital gains. Again, we'll discuss that in the future slides in detail. And other sources would include your income from interest, dividend, etc. So all of you would be aware that over the past 2-3 years, we have had two separate regimes, old regime and new regime. We don't know for how long the old regime will continue, given by how the things are going. Very soon we'll see only new regime surviving. For taxation purposes, individuals are categorized into three categories. One is below 60 years. Second is senior citizens between 60 and 80 years. And third one is super senior citizens, which is above 80 years. So there are different taxation rates for three categories and under old regime and new regime. Coming to the different ITR forms that are there right now. So ITR 1 is applicable for the resident individuals where the gross income is less than 50 lakhs and you have sources from like salary or pension. You have only one house property. If you have two house properties, then this form is not applicable to you. Where the agriculture income is less than 5,000 rupees and then you have interest from saving accounts, deposits, IT refunds, etc. ITR 2 is basically for individuals and HUFs who are not eligible to file ITR 1 and where say gross income is more than 50 lakhs, where you do not have income from business or profession. You are holding directorship in some companies or you have some unlisted shares of company where your sources of income include more than one house property, capital gains, foreign assets. Agriculture income is more than 5,000 rupees and you have winnings from lotteries or horse races. ITR 3 is for individuals and HUFs who have income from business and profession. This can be in the form of partners' remuneration or profits from a partnership firm or profits from a proprietorship firm, etc. And every income source which was there in ITR 2 plus this income from business or profession. Coming to the last form, which is ITR 4, this is for resident individuals and HUFs where the gross income is again less than 50 lakhs, where you have one house property. But one additional thing here is you have presumptive income from business or profession, where there are some provisions where you can just say that if you are earning 10 lakhs from a business, you can say 5 lakhs is taxable if say 50% is the presumptive taxation rate. Then agriculture income is less than 5,000 rupees and then the normal interest income that you want. ITR 5, 6 and 7 are there, but 5 is applicable for firms, LLPs, AOP, BOI. 6 is applicable for companies, be it private or public. And 7 is for trusts and companies having income from charitable purposes. Now, coming to capital gains specifically, it's a little complicated, so let's go asset class wise, where say equity under equities you have equity shares and equity MFs, both of which will be classified as LTCG if you hold it for 1 year. Less than 1 year is taxed at 15%, more than 1 year is taxed at 10% for gains above 1 lakh rupees. Real estate threshold for LTCG is 2 years, where if you sell it before 2 years, it will be taxed at your tax slabs, and if you sell it after 2 years, you get 20% tax rate with indexation benefits. Under fixed income, in the last budget, we have had some changes where debt mutual funds are taxed at your tax slab, irrespective of the horizon that you have. Listed bonds, more than 1 year if you hold, you get 10% taxation, and less than 1 year, it's taxable at your tax slab. Unlisted bonds, the period increases to 3 years from 1 year, and long-term capital gains of 20% with indexation. Coming to hybrid funds, again, this has come because of the taxation change which happened in the last budget, where if you in the hybrid fund where the equity is less than 35%, it's at par with your debt funds and it will be taxed at your tax slabs. Whereas if you have a hybrid fund between 35 and 65%, you get indexation benefits and long-term capital gains after 3 years of 20%. Obviously, if the hybrid fund is holding more than 65% in equities, it will be at par with the equity mutual funds, which is the second row. Again, this is as of now. This will probably change in July whenever the budget happens. Just one thing. So for ESOP taxation, this is applicable from an employee point of view, not from an employer point of view. So just take an example of an employee who has been granted options on 1st of April 2024 at 100 rupees per share. And the vesting period is 2 years with an exercise period of 1 year from that 2-year period. So vesting starts on 1st of April 2026 and he has time till 1st April 2027 to exercise the options. Say the fair market value on 1st of April 2026 is 300 rupees at that time. So until and unless the it is exercised, you don't pay any tax. When you exercise, say the employee exercises the options on 1st June of 2026 and the fair market value at that time was 350 rupees. At that time, whatever is the difference between the fair market value and the value of the share that was given at the time of grant of options, you have to pay tax and it will be added as a perquisite in your salary. So basically 350 minus 100 into the marginal tax rate that is applicable to that employee will be paid as a perquisite tax, and the employer is responsible to deduct this tax from the employee's salary. Now what happens at the time of sale of options? Say on 1st June of 2029, the employee sells the options at 800 rupees. So here the employee will have to pay difference between 800 and 350, which was the fair market value at the time of exercise of options, and into the tax rate depending on whether it's long-term capital gains or short-term capital gains, and whether it's unlisted or listed, depending on that the tax rate will be applicable. For tax payments, there are two types of challans mainly. Now we have more challans, especially for TCS on immovable properties as well. But Challan 280 is for your advance tax, asset tax, tax on regular assessments, etc. Whereas Challan number 281 is for TDS and TCS. 26 AS has become much more robust now than what it was when it was launched. It will give you a consolidated picture of all your earnings and with your PAN number. It's linked to your PAN number. It can be easily downloaded from the Traces website. You just need to log in with your income tax profile credentials and you will be able to download this. So what all it contains is TDS details, TCS details, all your advance tax payments, asset tax payments, income tax refunds that you have received during the year, any high value transactions that you have gone through, be it mutual funds, be it a sale of immovable properties, etc. And it also now gives you details of turnover reported under your GST return. So now they are trying to link both indirect and direct taxation, where if the turnover reported under GST is X amount, they will check whether you report the same in your income tax return as well or not. One more statement which they have started recently is the annual information statement. Again, it's a more detailed version of the 26 AS, where they give you item-wise bifurcation. So if you have dividend income, interest income, they'll give you from dividend from XYZ company, ABC company, interest from this bank, that bank, etc., etc. And the good thing about this is that in case of any errors, you can give feedback to them. And then in the annual information statement itself, you can see whatever is reported by the entities, be it banks, companies who give dividends, etc., and whatever is reported by you. So you can see the difference between what is reported and what is actually your income. So this helps in facilitating voluntary compliance, where given that, say, interest income from unreported field is there, but now you have to report it because it's there in the AIS statement, then it eliminates underreporting by the taxpayers. It enables pre-filling of income tax returns to a large extent because you can just pre-fill all the information that is there in that. And it deters non-compliance at the end of taxpayers. So let's move on to part B, which will be more interesting to a few of you, where we'll be looking at NRI taxation, foreign remittances, gift city, etc., etc. So, who is classified as a non-resident Indian? In order to classify as a non-resident Indian, you need to be outside of India in the previous year or the financial year for more than 182 days. If that condition is satisfied, then you become a This is if you stay for more than 182 days in the country, which is India, then you become a resident. If you don't stay for more than 182 days in India, then you become a non-resident. But there's a condition here. If you stay for more than 60 days in the previous year and you have stayed more than 365 days in the previous 4 years, then automatically you can classify as a non-resident, even if you don't stay for more than 182 days. And then there are other conditions where if you are a non-resident in 9 out of previous 10 years and present in India for less than 729 days in the previous 7 years, then you are classified as resident but not ordinary resident. Again, taxation differs for 3 categories: resident and ordinary resident, resident and non-ordinary resident, and a non-resident. So, what all sources of income do the NRIs need to pay taxes in India for? So, any salary which is received in India, any salary received for services rendered in India, any rental income which is received from a property situated in India, any capital gains arising from transfer of property or assets which is in India, any income from deposits in India, or any interest received on the savings bank accounts. DTAA or the double tax avoidance agreements are a lifesaver for NRIs, given that, so it's basically DTAA is a tax treaty signed between 2 countries where if a particular source of income is getting taxed in one country, they can claim that benefit and they have to pay only the differential in the other country. So this avoids double taxation on the income that happens. And while it was very easy to obtain this benefit before 2012, the Finance Act 2012 introduced a tax residency certificate requirement for all the non-residents, where if they don't have this TRC, it's very difficult to claim any benefits under DTAA. And another form which was introduced was Form 10F, where if the tax residency certificate doesn't include all the necessary information, you need to obtain this Form 10F as well. Obtaining a tax residency certificate is very, very difficult. Again, it's valid for only 1 year. So you have to renew every year, and at the same time, the cost is also very, very high. So what are the benefits of DTAA? One is obviously that, your income is not liable to taxation twice. Second is the taxpayer get clarity and certainty of where the income will be taxed and how much it will be taxed. So this saves costs on the litigation side. Third is increased investment and trade between 2 countries, given the agreements that are there between 2 countries. And last is improved tax cooperation, where exchange of information between those countries happen seamlessly. So, NRIs can open 2 types of accounts. One is a NRE account and second is a NRO account. So, we'll look at the differences that are there between these 2 accounts and what practical implications are there. Both the accounts are denominated in Indian currency, so there is no foreign currency risk here. All the interest that you earn on your NRE accounts is tax-free. There is no tax on your NRE deposits. On NRO account, you are subject to TDS and tax is deductible at source. In terms of repatriability or taking back money to your foreign country, NRE account is freely repatriable, where you can withdraw your money easily. Whereas NRO account, there is a limit of $1 million in a financial year. And that too, you have to prove that you have paid your taxes on that income and then you are repatriating it. In terms of joint holding, for NRE account, you can open with another NRI or any close relative who is an Indian. NRO account can be opened with anyone with an NRI as well as an Indian resident. The third type of account which I have not covered is a FCNR account or a foreign currency account, where the denomination is in US dollars, but there again you can only invest in deposits there. So for investments into financial markets, NRIs need to have PIS accounts. Again, I have divided and differentiated between PIS account and non-PIS account. PIS stands for Portfolio Investment Scheme. Portfolio Investment Scheme account, enables you to invest in a broad range of securities, be it stocks, bonds, mutual funds, real estate, etc. Whereas non-PIS account has a restricted set of securities, mainly stocks and mutual funds. Investments can be done from both NRE and NRO under the PIS account, whereas here only NRO accounts are supported. In the PIS account, you need to open an account with a partner bank of the broker. So, for example, if you open an account with Zerodha as a broker, Zerodha may have tie-ups with only 2 banks. Then you need to open an account with that partner bank only. For non-PIS account, NRO account can be with any bank. For PIS account, a PIS permission letter from RBI has to be obtained via the bank that is registered with your broker. Whereas here, you don't need any permission letter from the RBI. In a PIS account, the bank has the responsibility to deduct TDS for short-term, long-term capital gains. Whereas in a non-PIS account, the broker is responsible for deducting taxes. For PIS accounts, the global restrictions which are there on maximum foreign investment or INRI shareholding in a company, they are applicable. So, for example, if HDFC Bank has hit a cap of maximum foreign shareholding, then no new PIS account holder can invest in that. Whereas in non-PIS account, there are no such restrictions. Here you can invest in direct mutual funds, whereas here direct mutual funds, here you cannot invest in direct mutual funds, whereas in a non-PIS account, direct mutual funds are allowed. In a PIS account, funds need to be transferred from your bank account to your PIS first, and then the bank will convey the information to the broker that the money has been transferred. Whereas in a non-PIS account, funds for investing has to be transferred from your NRO bank account to your trading account using your net banking, which happens with our resident trading accounts as well. And in both the cases, BTST, which is buy today, sell tomorrow, is not allowed at all. Now, coming to difference between inheritance and estate tax, and this mainly is from US NRI's point of view. So, estate tax is levied on the estate of the deceased, whereas an inheritance tax is levied on the individuals who are receiving the inheritance from the deceased. When the state taxes apply, any estate tax which is paid, to the state in which the deceased resided, whereas inheritance tax is paid to the state where the recipient of the inheritance resided. So, this is the difference between the two. In estate tax, you have a federal tax that is there in US, and then you have a state tax also for 12 states that are mentioned. And the tax rate varies from 0 to 16% over there. Whereas inheritance tax, there is no federal tax, there is only a state tax, and currently about 6 states have that state tax. In estate tax, 13 million is something which is defined for this current year. Again, they keep revising these limits, but anything above 13.61 million, you have to pay tax on it. And the tax range is between 18 and 40%. So as I said, inheritance tax is basically a state levy on the assets that an individual receives as a part of the inheritance. And that depends on 3 conditions. One is your relationship with the deceased. Second is the value of the asset which is transferred. And third is the state of the deceased where they resided at the time of the death. So if most of the states exempt spouses from this inheritance tax, so that benefit is given. So if someone dies, their spouses are not taxed on the inheritance. Currently, 6 states which I have mentioned impose an inheritance tax: Iowa, Kentucky, Maryland, Nebraska, New Jersey, and Pennsylvania. Iowa is something which is eliminating this tax from next year onwards. Inheritance tax is payable only if the transferor or the deceased is a citizen or a resident or a green card holder of US. If the US citizen is inheriting property from a person who is not a resident of US or who is not a green card holder, then this inheritance tax is not applicable. Now, coming to PFIC regulations or a passive foreign investment company regulations, so this has hurt US and Canada citizens from investing in mutual funds especially. So the conditions there are that at least 75% of the corporation or the passive foreign investment company's incomes should be passive, that is dividends and interest received from your investments. And at least 50% of the company's assets are investments. So most of the foreign mutual funds and the pooled vehicles come under this category, and hence they come under the PFIC regulations. So this regulations came back in 1986, and they were designed to close a loophole where people were using these kind of structures, offshore structures, for saving taxes. So there are 3 tax options that are available. First one is the default option that is there. If you don't do anything about it, this first option will be applicable, where you are taxed when you exit your investment. But whatever gains you have made, they will be proportionately allocated for your holding period. And for the years in which you have not paid taxes, you will be levied fines and penalties. So this is the most punishing kind of taxation that is there. If you don't choose anything, then this is the tax that you will be liable to. Second option is the MTM, which most of the investors now opt for, where any unrealized gains or losses from your investments are taxed on an annual basis. So, for example, if you invest $1,000 in a mutual fund in India and that grows to $2,000 at the end of the year, you have to pay taxes on that $1,000 irrespective of whether you sell or not sell. Even on your unrealized gains, you have to pay your taxes. And third and the last option is a qualifying election fund, where most of the PFIC investments are not eligible and they must comply with some of the basic regulations. But broadly, first 2 options are the most common ones, where if an investor is educated, he will always take the second option. Now, coming to foreign remittances, as you would all be aware that under the liberalized remittance scheme or the LRS scheme of RBI, every individual is allowed to remit $250,000 per year. And this limit is per year, per person. This limit gets revised every year, and you can do transactions n number of times. So you can do 50,000 today, 50,000 tomorrow, etc. But the total should not exceed $250,000. And as in my previous slide, I said that NRIs can repatriate a maximum of $1 million from their NRO accounts without paying any tax on money transfers from India to US. But again, this is something which has come in where TCS is applicable at 20% on your foreign remittances from 1st of October 2023. Just one slide. Again, succession planning was covered in the previous presentation, but just to expand a little bit on it, just as an example, if a couple is staying in India and they have children abroad, what happens if the parents living here die, and how the succession planning happens? So they have to go through this process where they will not be liable to, the children will not be liable to any inheritance tax or estate tax in US. So one first condition is that the will must be probated in India. Second condition is you must have a lawyer or a legal presentation in India, and he should have a POA to act on your behalf. That is, the children should appoint a lawyer in India, and the lawyer will be acting on their behalf. Third is adequate documentation should be there, where they have their passports, address proofs, tax identification numbers, etc. All the documents are in place. Fourth is the beneficiary or the children in US, they have to file their tax returns in India and comply with the Indian tax laws. And they have to obtain a tax clearance certificate, which is a Form 30 from the IT department in India. Fifth is, after this probate is completed, the transfer of assets happen. And the sixth step is remittance of funds to USA. So the beneficiary must obtain a certificate of inheritance from the Indian court, and then the money can be transferred. And the last point is compliance with the US tax laws. This is very, very important. So where the beneficiary must report these inherited assets in their US tax return. And they should file their annual return to report transactions with foreign trusts and estates if this is applicable. So coming to the various treaties that India has with different countries and how NRIs investing in India are taxed from different countries. So in most of the countries, for investors holding shares of Indian company, all of them are taxed in India only. Whereas for units of Indian mutual funds and derivatives, it differs. So there are three countries. If the NRIs are based out of those three countries, the local country doesn't charge any tax. So Mauritius, Singapore, and UAE. But these comes with riders. One is you need to have a tax residency certificate. You need to prove that you are a resident of that, and then you need to get a clearance from the IT department saying that you have a tax residency certificate and you don't need to pay tax over there. In Singapore, there is an additional condition where you have to repatriate the gains that you have made, and then only it will be tax exempt. One exception for the investors holding equity shares is Korea, where if a Korean is holding shares of Indian company, they are taxed in Korea. They are not taxed in India, except if he holds more than 5% in a company. So as I said, they need to get a form which is called Form 10F from the IT authorities, and after that clearance only they can claim these DTAA benefits. Again, as I said, getting a tax residency certificate is not only difficult but also expensive, and you need to renew it annually. Now, coming to Gift City, so we'll talk about both outbound and inbound, and I'll explain what I mean by outbound and inbound. So if you are using a Gift City vehicle for outbound investments, so residents in India investing in foreign securities, then the investment manager needs to have a Gift City branch with a requisite employee strength and qualifications. So those are very well defined in the regulations that are there, where you need to have a minimum of 2 employees with requisite qualifications, and you need to have a physical presence in Gift City as well. Regulator for this is International Financial Services Center Authority, or the IFSCA, which is called, and this was formed under the Act of 2019. For this, the LRS limit of $250,000 is applicable, so you cannot remit more than $250,000 for an individual. But if you have any company that can remit 50% of your net worth through the OPI route, or the Overseas Portfolio Investment route. So most of the promoters would have, say, private companies. They would be using this route to remit dollars abroad and then invest it abroad. The minimum ticket size is $150,000. So again, here I have mentioned for an accredited investor is $25,000, but most of the cases this is not applicable. $150,000 is something which is the minimum ticket size for an investment through the Gift City. And in terms of taxation, for any foreign security which is held for more than 2 years, you get long-term capital gains tax of 20% with indexation benefits through the gift city. Whereas if you are investing directly in foreign securities from, say, Mumbai, then you will be taxed at your tax slab. So this is a tax advantage which has been given to the vehicles that are based out of gift city. For NRIs that are investing in this kind of a vehicle for outbound, they are not taxed in the gift city or India, whereas they would be taxed in their own country. Now, coming to inbound or non-resident investors investing in India. So there are two columns here. One is through a AIF based in gift city, whereas the other column is AIF which is in India outside of gift city. So here you can clearly see that the long-term capital gain and short-term capital gain rates are almost the same. For derivatives, an exemption has been given in terms of AIFs based in gift city, where there is no tax applicable on derivatives. Again, in terms of dividend income for AIFs in gift city, its tax is only 10% compared to 20% for the other AIFs. Interest income is the same. Amounts in brackets are the ones with cess and surcharges, whereas amounts on the left are without cess and such. Now, coming to the last structure, which is their family investment fund. So, this is an answer to HNI families setting up family offices in foreign countries. So, instead of that, the government wants them to set up in gift city. A family investment fund is a managed fund which can pool resources from either a single family or various family members or companies which are owned by the family members, where they have a substantial economic interest, which is 90%, which is defined. They should own more than 90% in those companies or LLPs or firms. And FIF will be considered as an Indian resident for all tax purposes, and overseas resident or a offshore unit from a FEMA perspective. So there is differentiation between income tax and FEMA. Investments can be made in a family investment fund through the family-owned entities, again through the OPI route, which is 50% of their net worth. And this can save, any individual family members LRS limit of $250,000. So if you are remitting through this, that limit can be used for something else. You get a tax break for 10 years. There is no GST, and a minimum threshold for this is $10 million. This has been there for about 2 to 3 years now. Only one family office has been granted up in principle approval. Again, they have not set up the fund yet, but they have got in principle approval. Don't know how much time will it take to get the ball rolling here. That's it. Thank you. Any questions?
Can you go to the PFIC slide, please?
Sorry.
The three options that you spoke of, and within that, the first option.
Yeah.
Very often I have seen that people actually like to go with the first option. And versus, I think you said, correct me if I'm wrong, you said the second option was a much better thing, that, the notional income. So if you could just once again elucidate the difference, and because I have some people who are actually doing the first one.
To my understanding, in the first one, it's very akin to retrospective taxation, where, you don't pay taxes till you exit, but the income is allocated to all your previous years of the holding period. And then you have to pay taxes on that. And since you are paying taxes late, you are levied fines and penalties on it. So actually you are paying much more taxes on it. Yeah, the default option. Whereas in the second option, every year you are paying on your unrealized gains. So there you are not paying any interest or penalty.
That it is.
Yeah. Correct. No. Most of the investors that we have take the second option. Yeah.
Thanks, Raj, for the presentation.
Thank you.
I had one question on the indexation benefit. What has been the typical average rate or the benefit you get with indexation?
Roughly in the range of 3 to 5%, depending on year to year, but 3 to 5% you can say. So the net tax comes down to 15-16% kind of.
You had a slide on the PIS. Can we go to that slide?
Yes.
Yeah. Now, in PIS, earlier what we were dealing with on a practical basis, all the NRE accounts were automatically covered under PIS. NRO accounts were never covered under PIS. All of a sudden, all the brokers and banks have woken up to deduct TDS on the NRO sales. And the broker say, we don't have the wherewithal, so now you open a PIS account for NRO. Can you clarify what is the confusion and whether this will also at some point come into mutual funds?
Don't know much about the practical implications. This is what I have read, that this PIS account can be with NRE or NRO, whereas this only can be NRO. I don't know what practical implications have been of this or what practical difficulties the brokers have faced. I'm not too sure on that.
Is TDS applicable on the NRO account when he sells shares?
Yes, it is applicable.
That was not being paid by the broker.
No, it is applicable. The only difference is in PIS account, the bank deducts TDS, whereas in a non-PIS account, the broker deducts TDS. So that's the only difference.
Any possibility of PIS coming for mutual funds also?
Nothing in the news at least.
This LRS scheme, let's say you are transferring X amount overseas. Now you are not accountable for that money. That money is out of the Indian tax net.
So once it's gone offshore, you are not liable to bring it back. You can keep it abroad.
It's not liable to any Indian tax authorities.
No.
It's over. If you can gift it to whatever.
Only thing is there's exchange of information between governments now, so they would know where that is invested.
But if you have gifted it to somebody, then nothing.
Raj, you spoke about the hybrid fund. Now you said the moment hybrid fund invests greater than 65%, you automatically qualify for 10%.
Yes, correct.
But how will I know that my fund, what is the base year that suppose when I put my money into hybrid fund, it is less than 65 years. And suddenly after 2 years, I realize it has gone up to 65%. How will, as an individual, I will come to know whether the AMC has changed it or not?
So most of the fund houses don't change this. So whether if it's above 65, they will try to keep it above 65. Again, this limit is on a 12-month average basis. So if in a particular month this goes above 65 or below 65, it's fine. But on a 12-month average basis, if it's above a certain limit, then it's fine. Okay, thank you.
Whenever things got rough, I always remember what my father used to say.
Running a business does test a man, my son. There are ups and downs, glorious highs, and sometimes a low that leaves you feeling defeated.
The character of a man and the character of a business are not very different, are they?
Yes. But when the chips are down, we must stand up, dust ourselves off, and motor on.
Volatility. It's a funny thing. It makes you question yourself and wonder if you've made all the right decisions.
Sure, you can question some of your decisions, but stay steadfast on your goals.
Dad always said, there are no shortcuts and no quick profits.
There are no free lunches, are there? There is only one
Right way.
At PPFAS, we think like Rahul and his father. That volatility is a fact of running a business. And buying equity shares is like owning a part of that business. We use value investing principles to manage your money. This means we invest in the right businesses at reasonable prices and for a longer term.
PPFAS Mutual Fund. There's only one right way. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.